So Garry, what would you say were the key benefits for someone wanting to invest in, well, to put a commercial property into their pension scheme?
There's many benefits to putting a commercial property in a pension scheme. We've touched on a few of those from a business point of view, but it's worthwhile going through some of the wider benefits of pension schemes in general. So with pension schemes, there's no income tax payable on rental payments. So if you owned a property personally, you'd be liable to income tax on that rent. Into a pension scheme, that doesn't apply. Rental income, as we mentioned before, it's investment growth. It's not a contribution, so you can further boost your pension savings whilst retaining that annual contribution. There's no capital gains tax on disposal of a property within a pension scheme. And similarly, there's no IHT on death. So if you're holding a property on death, it's held outside of your estate in a pension scheme in trust. Also, if you're a business owner and you own a property within your pension scheme, if the business was to run into any financial difficulties, then it potentially wouldn't be accessible by any creditors. It comes with a very big caveat that you shouldn't be putting property into your pension scheme if you know that you're in financial difficulty. However, if by coincidence you've got a pension scheme with a property in it, the business goes into financial difficulty, then it should be safe from any creditors moving forwards. If the business is a tenant in a property and thus paying rent to a third party, by buying a property and putting it into your pension scheme, you're actually redirecting that rent back to yourself. So again, it's a way of injecting cash into the pension scheme and not paying a third party. And as we mentioned as well, the cash injection, if you own a property either personally or via a business, and you sell it to your pension scheme, then you'll be in direct receipt of that money. So personally, you can pay off a mortgage or any other debt you might have, and similarly a business, and as we mentioned, it can help it to grow and prosper.
That obviously sounds great, but with anything that's great, there's always drawbacks, particularly tax implications or things like that. So what are the things really people should be aware of, that might be sort of a negative consideration when investing?
Yeah, of course, as I mentioned, loads of benefits, but as with anything, there's always drawbacks to consider as well. So I'll just run through a few of those. Whilst we've mentioned that pensions are tax-free vehicles, there may be tax due on the way in. So if you own a property personally and you're selling it to your pension scheme, CGT may be applicable on the way in. Likewise, some properties are subject to VAT. Pension schemes, as we said, tax-free, so you can in theory reclaim that VAT, but in some cases that might not be possible. So if you're a VAT-exempt business, then you may have issues. So it's really important that you seek professional tax advice about that. Luckily for us at Ward Goodman, we've got a firm of expert accountants and personal tax advisors that we can lean on. But it's really important that clients, business owners, seek that advice before going ahead with a property purchase. But also, if a property is subject to VAT, whilst you might be able to reclaim it, you need to have the money in the pension scheme in the first place to pay it. So a property valued at $500,000, you'd need an extra £100,000 in your pension scheme to cover that VAT cost up front. Moving that on a step, stamp duty land tax is also applicable. And for a property that is subject to VAT, the stamp duty is actually calculated based on the purchase price plus the VAT. So using our £500,000 example, you'd be paying stamp duty on a property worth up to £600,000. Properties, once they're bought by a pension scheme, they're owned by the pension scheme and not the business anymore. So businesses can't use them as security and borrow against them. Rent to the business must be at market level, as you mentioned, and so therefore it's non-negotiable. If you owned it via a business or yourself personally, perhaps you had no rental outgoings previously, so there could be an increase in outgoings for a business. Properties can be vacant, so you've got a risk from that point of view. If you can't get a tenant in, then you're not getting any income in. Properties are generally very illiquid. If you want to pay any benefits, take any drawdown from a pension scheme, or if you've got mortgages or any other outgoings in relation to that property, they still must be serviced, which is very difficult if you haven't got a tenant paying any rent. And finally, property, of course, is an investment. So whilst they can go up in value, they can also go down in value. There's no guarantees there.
I'm sure you agree we've covered a lot today. Thank you very much, Garry, for coming, and thank you, Caroline, and hopefully that's answered a lot of questions that you may have.